help to break us down the government spending data, next week's CPI report, and more. SMBC Nikko chief economist Joe Lavorgna on what we can expect. Joe, great to have you with us. I'm curious, what's your take on the consumer? We were having this, discussion about the consumer and where the cracks are, and certain consumers are under more pressure, et cetera. What's your take on overall consumer spending as it relates to the component of the economy?
It's a big piece, obviously, 70% of GDP, and consumers will keep spending as long as they have jobs. And at the moment, they still have jobs, which is good. However, where I do foresee a problem is on the good side, because if you look at the pre-pandemic trends, we're about 8% above the pre-pandemic trends, with generally credit conditions starting to tighten a bit more from where we were a couple of years ago. Interest rates for a lot of durable borrowing for homes, certainly appliances, furniture, those rates are high. At some point that will slow. But the first thing, Melissa, the labor market really has to weaken. The consumer always, even whenever the next recession comes, always generally looks pretty good until all of a sudden the consumer doesn't. In other words, consumer spending is a measure of current activity. As much as we try to look at various company reports and what the guidance is, consumer spending never tells us about where we're going. It's the confidence numbers you were talking about at the top of the show. Actually, they tend to be more forward-looking. Of course, they were lousy. That's right.
Terrible.
That's right.
So what does that tell you?
Well, it tells me, here's the thing. To come full circle, what it tells me, Melissa, is that the inflation data is likely, and I'm not sure exactly why, I've got some theories, but the inflation data is all of a sudden now look really poor. Next week is likely to be 4 months in a row. If the economy doesn't slow, if this no landing scenario continues to play out, then the Fed has to keep rates high and maybe even hike rates so as to slow the economy and moderate inflation. The only way out would be if you got a big increase in productivity growth, such that potential GDP is higher and all of a sudden inflation starts moving lower again. That could happen, but that to me is that's sort of a little bit of a fairy tale. It doesn't sound like it's likely to happen. So it's going to rest on the Fed, and then you do get the downturn. But when that is very hard to say.
So, Joe, great to have you. Let's get to another fairy tale that the U.S. is going to actually balance their budget sometime soon. I mean, for 50 years, we went 2% of deficit on the budget. Budget had a 2% deficit. The last one I saw was over 6%. This matters, and it probably also makes GDP higher. So at what point do you put your kind of credit hat on? We kind of scoff at the credit agencies when they downgrade, but this is real, and it's not going to change anytime soon.
Yeah. So if you look at the CBO numbers, they've got the 10-year note at roughly 4%, 4.2, 4.3 for the next 30-odd years. There's no recession, unemployment low, and the deficit goes to about 9%, close to 9%. So clearly there's going to be an issue. Now, fast forward to next year, and let's assume we can make whatever assumptions we want to make about who's in office, but the deficit numbers certainly going into next year will remain terrible. We're running 5-6% budget deficits with unemployment at 4%, slightly below. That's unheard of. The rating agencies, if you remember when they downgraded back in 2011 and when they warned in the past because of the debt ceiling, it was politics. And if the politics don't get better, as Karen was saying, there's going to be some fragility there. So the rubber may meet the road, Tim, next year, but there's certainly no way we can keep the spending going. And part of it, though, is the Treasury's own mistake by basically 80% of all the net issuance in the last year has been within 1 year. And that yield curve inverted is the reason why, as we were saying before the segment began about interest payments, they're high because the curve's inverted and the Treasury's financing everything at the front end.
Joe, it's Karen. Let me just push back for a second on the productivity thought that you had. Is it possible that there is greater productivity than we think? I mean, how else would we explain the GDP numbers that have been so strong? This last 1.6, I guess, notwithstanding, but, in the threes, is that not due to some significant productivity gain?
It is due to some significant productivity, and productivity growth has improved. We've seen labor force participation, although it's still below where it was in 2020, beginning of 2020. It's come back, so that's part of it. But if that's the case, though, Karen, we should start to see these inflation numbers quickly move lower because if there's more slack in the economy because the economy's potential is higher, because productivity is higher, then inflation is supposed to move downward. And consumers, you talk about McDonald's, the numbers today out of Michigan were very surprising. I was surprised to see those inflation numbers, especially with gas prices, kind of okay at the moment. They're not really spiking much. So to me, there's a lot of angst and stress out there on the consumer side because living standards have fallen because inflation's so high. And that likely is a function of the fact the government's been spending way too much money. We've avoided recession, but we're paying for it on the price side.
So, Joe, I'm going to take it from a different angle. Shelter costs are over 30% of CPI. So is the Fed sort of backed himself into a corner where they have to cut rates because that's the only way shelter costs are coming in? And if shelter costs are tied to CPI, that's the only way CPI is coming in. So if they don't cut rates, you're actually not getting lower inflation.
I heard that. I don't know if I believe that argument, but I'll give you the easiest way to answer it, Steve, is that the Fed focuses on the core PCE, and the rental piece in the core PCE is about a third of the size. If we take the core PCE and we break it between the cyclical and the structural or the non-cyclical pieces, we need about a 2.5% drop in the core, the cyclical part of the core PCE, and that doesn't happen outside recession. So what I think winds up happening is CPI might come down because of the rents, and if the Fed cuts someday, rents will come down. But what the Fed focuses on is not heavily rental driven; it's healthcare driven, and healthcare costs are not coming down.